So I tried a lot of stuff, hit a lot of dead ends, made plenty of mistakes, learned from those. Some were, luckily some were small mistakes, big lessons. Sometimes they were big mistakes, same size lessons, but at least I learned lessons, and I never want to pass up the lesson from a good failure, right? All I was looking for was passive income. I wanted enough cash flow coming in that it covered my necessities, and then it covered my lifestyle, and it covered anything beyond that. So you ask, how did it happen? A lot of it was by chance. You run into somebody, you do a deal, turns out to be a good deal. You run into somebody, do a deal, turns into a lesson instead, right?
All right, welcome to another episode of the Legacy Wealth Podcast, where we help accredited business owners become educated and get access to private investments to help them build their legacy. I'm your host, Pascal Wagner, and today we have on the show Tom Burns joining us from Austin, Texas. Welcome, Tom.
Hey, thanks, Pascal. Glad to be here.
Likewise, happy to have you. So I'm going to give a quick bio on Tom. So Tom and I know each other through a men's mastermind group called GoBundance. He's 64. Like I said, he lives in Austin, Texas, and he's married with 2 kids. They're adults now, doctors and firemen. But he's a principal at a private equity, a real estate firm in Austin. He's a physician for the U.S. ski team. He's an author of a best-selling book called Why Doctors Don't Get Rich. And he runs a mastermind to teach people how to invest and run private funds. He began investing in private investments in 1995 and has invested over $1 million in over 10 deals as an LP. But primarily, he's raised over $250 million as a general partner for over 50 different deals. So private placements make up over 80% of his investments, including multifamily, medical offices, hospitality, manufacturing, student housing, mobile home parks, private equity, retail real estate, oil and gas, venture capital. He's done it all. He's got the gamut. So I'm excited to have him on the show today and share everything he knows. Tom, how did you get involved with the U.S. ski team?
Oh, so yeah, like everything, there's all these thin threads in life, right? So, I was a doctor, right? I was an athlete when I was young, found out nobody was going to pay me for it. So I figured, how do I keep hanging around athletes? So I became an orthopedic surgeon and a sports medicine guy. The guy I trained with was a gentleman named Richard Stedman, super famous orthopedic guy. We trained in Vail, Colorado, and he's the guy that kind of set up the ski team medicine. So that's where I hooked up with the ski team. 1991, I was the physician for the Olympic Training Center in Lake Placid. And actually, I was young and still reasonably athletic. So I jumped. These are the ones that jump. So I jumped with them, jumping up, doing the flips and stuff, into the pool. So I trained with them. And so I've been covering the freestyle ski team for the last 30 years. The guys that jump up in the air and do flips and land and look like they're going to kill themselves, and the ones that come down the moguls. So it's been a blast. It's been a good way to see the world, and it's a great bunch of kids.
I love that. You're right back in my home hood of Vail. That's one of my favorite places to ski. So I love that. So you eventually then, you've built this whole career as a general partner, and you've also invested in other deals. What was the story? What's the trajectory of how you got started?
I knew nothing but sports and chasing girls, and at least I was moderately successful in sports, right? So that's all I knew. And when I pretty much realized nobody was going to pay me for that I went into med school. And so, they don't train you. There's no business training in med school, right? We're specialists, and good entrepreneurs are generalists. So I go through med school training. Then for those that don't know, after med school, you do what's called a residency. So that was 5 years plus a 6th year of sports medicine. I was in the middle of my residency, and we're trained in an apprenticeship program. You think back, blacksmiths, plumbers, carpenters, apprenticeship, right? So we do this 5-year apprenticeship. So the people that are teaching me are, by extension, that's me in 10, 20, 30, 40 years, right? So I watched these guys, and they made a lot of money as physicians, but they weren't happy. They were on their second or third marriage. They were in the hospital at 11, 12 o'clock at night when guys like me had to be there. I'm wondering why these guys had to be there. they were complaining about their lifestyle. And this happened enough times that I eventually realized that I didn't want their money if I had to have their life. That's not what I signed up for. I always intended to just enjoy life and have fun. So I thought, I got to find a way to make some sort of income that's not correlated with medicine. I didn't know what that was because, again, I'd had, zero business classes. I didn't know anything. So I didn't have the money or the time to do stock trading. I couldn't start a business. I thought I was going to go into administration, but I found out that I was completely unemployable. But it looks cool when you wear scrubs. You think, well, carrying a briefcase and wearing a suit's cool, right? Well, that was a job. So I ended up landing on real estate. And as you know, real estate's simple. It's just math. You buy something and you let somebody use it and they pay you enough money to use it that there's a little bit left over in the end and you get to keep the leftovers. That's real estate. So I started learning about it. Still didn't have two nickels to rub together, but at least I had time. I was able to learn and I learned what I could. And as soon as I got out and, paid off a few bills, paid my parents for the groceries that they helped me buy because I was busted when I hit Austin. Don't feel sorry for me. I had a doctor's income, right? As soon as I had the time, I just jumped. I figured that's what you do. I just bought something and didn't know my head from anything else. I didn't know what I was doing. I just started buying.
Got it. Okay. So you started investing and one of the first things you did was like maybe buy a single family home and start renting that out. Was that the same for you?
Close. Yeah. I bought, I'm in Austin, Texas. I bought, and so had some relative coming down to go to Texas. I thought, tenant. So I bought a student property. I literally looked in the newspaper, and for the millennials listening, that's a sheet of paper that's got print on it that has ads and things like that. That's all we had back then. And on the back was a little real estate section, and there was apartments and condos. I found a deal, had a name on it. I called that. I said, I'd like to look at this. By then, I knew the math, right? It was simple. I could, you could figure out if it was going to make you some money, right? So I call this guy. We meet down at this single student condominium. He shows me the deal. Looks like it's going to work. The math that I did seemed positive. So I said, yeah, well, let's buy this. He said, great. I said, how do we do that? He goes, I'll put in a contract. Okay. So he puts in the contract. We win the deal. He says, great. You got the deal. I said, awesome. What do I do next? He goes, well, you got to get an inspection. You got to get insurance. You got to get a loan unless you're paying cash. Of course, I wasn't paying cash. I said, that's awesome. What do I do? Right? Pattern here. He goes, I got to an inspector, and I went and called some banker friend and said, look, I'm buying something. I'm supposed to get money from you. So what do I do? He says, well, give me a personal financial statement, the last 2 years of taxes. And I got mad at the guy because he kept asking for information. So I knew nothing, Pascal. I knew nothing. So I'm fighting through this thing, and we finally, we get it bought, right? And that made me about $100 to $150 a month in passive cash flow. That's the drug I was searching for. I thought, this is pretty cool. I didn't have to see a patient. I didn't have to do anything. It came in. I couldn't stop it. It came in every month. So I called the guy up. I said, this is awesome. You got any more? He goes, sure. I got one down the street. So we go down the street, look at another one. Math works out again. This time I knew a little more. It took me less time, but I still learned a bunch of lessons. We bought that one. Now I had two. I said, you got any more? He goes, sure. Well, I bought another. Pretty soon I got so good at that market that I could tell you in 5 minutes if it was a good deal. I got so good I bought one sight unseen that I still own today. I bought one for no money down. I wasn't planning on no money down and would never recommend that, but I knew more than the selling broker and the seller himself. It appraised for much higher than I bought it for, and they actually wrote me a check at the closing table. So that knowledge, I got good. I knew nothing. I understood that asset class. So that started things. I had that portfolio of these things. I bought some other stuff. I bought some really ugly piece of property that had a cell tower on it. Cell tower covered everything. People started finding out that I knew how to close deals. I knew how to find deals. And so people were bringing me deals. People were coming and saying, will you be a partner with me? And so we started buying multiples, and, things just escalated from there. It's the same math. There's just more zeros on it now. And so, I ran across partners. I will tell you one thing, Pascal, and stop me if I'm talking too much.
No, I love this. This is great.
So that's all I knew. Back then, I don't want to say like it, it was Great Depression or something, but back then there wasn't, I didn't get it. I didn't barely had a computer at this time,
What are we talking, like 1990 or?
We're talking mid 90s. We're talking 95, 96, 97. So, I had a computer, you type DOS commands into it. And so we didn't have access too much to other people's deals, right? So I thought that's what you did. If you were in real estate, you bought your own stuff. So I reached a point where I had a nice little portfolio of these little dink things, and they were making some reasonable money. I had a friend who was a developer, and we'd vacation together. I said, "Look, I really like what you do. Will you teach me?" Laughed at me, looked at me, and said, "Well, you're a rich doctor. You don't need to know this stuff." I said, "That's all right. Just teach me anyway." So I worked for him for a year and a half for free. Not only for free, I was canceling offices in the afternoon so I could go, learn. We were doing build-to-suits for banks. We were looking at land. We were doing stuff like that. So it was costing me because I was canceling revenue-producing office hours. But I knew that's where my future lie was in creating my own streams of income rather than counting on seeing more and more patients. So I learned a lot from him. And out of that came something you and I talked about. We ended up putting together an office project. And so we built a 150,000 square foot medical office complex that we still own today, just the two of us. So I learned from him. A great asset came out of it. Later on, I was speaking on stage for somebody in Arizona in 2001. And the guy said, "Yeah, and Tom's from Austin, Texas." At the break, somebody comes up and says, "We're moving to Austin. Will you be, kind of be our contact so we don't know anybody in Austin?" I said, "Sure." Well, I got to know that person over the next 4 or 5 years, and that's my current partner in Presario Ventures. So there's really small threads that connect people over time. And I think I've done whatever I've done, I've primarily done by having partners that are smarter than me and using the team concept rather than what intellect I might have. We just all kind of try to do our jobs.
Wow. Okay. So to recap, you as a 30-something doctor, you started making, the real money that doctors make, and you started paying everyone back and slowly starting to buy pieces of real estate here and there. And then, build up a portfolio, you were hanging out with one of your friends who happened to be a developer. And then he was teaching you how to really invest in, I'd say, commercial real estate. And then that's where, that was probably your first deal that you did together with that mentor of yours. Is that what I understood? Wow. Okay. And so then, walk me through. You were then, you were this guy's contact in Austin. You guys became business partners. And then at some point you decided, hey, this doctor thing isn't for me. I want, when do you make the transition? Were you 35? Were you, did you already have a bunch of passive income? Like, walk us through that and why? Yeah.
Yeah. And that's a good question. I'll surprise. The why is pretty easy. My wife and I had a deal. We're going to go through life, whatever it throws at us, we're going to have fun. And part of my fun is travel. And you can't travel when you're sitting in an office seeing patients, right? I want to see the world. And so I'd like to put a pin in every country in the world. We'll see how close we get, right?
What are you at?
I don't know. Again, I haven't counted the numbers. I'm just not left brain enough to want to do that. But I'm going to do that one day. But been to a lot of weird ones, Belarus and Kazakhstan and weird Afghanistan, places like that. So yeah, you'll see me in a lot of weird places. But okay. So you're asking. So I was an athlete and I'm in sports medicine. I was having a good time. I loved medicine. And you can really love what you do, particularly when you start gaining a little control over it. So I was never trying to leave medicine. All I did was once I got enough past it, I didn't want to be beholden to seeing somebody, right? I wanted to have my own streams of income to, take that from Robert Allen, extra streams of income, right? I just wanted control. I didn't want anybody telling me what to do. Put it that. Maybe I'm just narcissistic. I just don't want anybody telling me what to do. And so that's what that was doing. So I just slowly, the first thing I did, Pascal, was, I was a young doctor in town. So working all the time, working weekends, doing all that stuff, burning the candle at both ends because I'm doing the real estate stuff as well while doing full-time doctor work. There finally came a time when I thought, yeah, I got a little income. It wasn't life-changing income, but it made me feel good enough that I cut out Friday afternoon office. And, when you work all the time, it doesn't, you take off Friday afternoon. I was like King Tut, man. I had a 2.5-day weekend. I was awesome. I didn't have to work Fridays, and that was a good feeling. And that's all I did was I just kept changing the scales. So, then I'd cut off Tuesday afternoon, then Thursday. And so as things progressed, to answer your question, I loved medicine, and I loved it even more because I eliminated all the annoying crap that you have to go through, or most of it. And I didn't have to be beholden to any hospital or any patient or any insurance company. If I didn't like what they did, I'd fire them. So medicine was fun. I only stopped 2 years ago not because I wanted to get out of medicine, because I just ran out of time. There was more to do. And so I only stopped 2 years ago, but I probably practiced medicine for, I think it was about 13 years when I didn't need the money. So I eclipsed the income of an orthopedic surgeon eventually, and that just kept growing. So I know it's a little different story. I wasn't trying to exit. Now I can't imagine going back, but it was a hard decision to actually stop practicing medicine.
Give me the storyline of how you transitioned from, okay, you bought all this student housing, and then all of a sudden, you've told me that you've invested in all of these different asset classes, retail, medical office, how does that come about? And are they all your own deals, or those deals that you're investing in?
Yeah, it's a good question. Well, I think I'm the poster child for attention deficit, right? And we've all got fears, but I'm just dumb enough. I'll just jump into a deal to go learn. I do the due diligence. Got a lot better due diligence, by the way. But a partner, that same partner, we bought a restaurant, and I always suggest to people, don't, right? So I owned a restaurant, owned that for 10 years. Owned a ranch in Africa for 10 years. So all these were my deals. It was just me investing. If we needed money, I'd go get investors. That's how that happened. I eventually kind of ran out of money for the deals I was doing, and I just started started grabbing friends, family, and acquaintances, and things just grew over time. And so so I tried a lot of stuff, hit a lot of dead ends, made plenty of mistakes, learned from those. Some were, luckily some were small mistakes, big lessons. Sometimes they were big mistakes, same size lessons, but at least I learned lessons, and I never want to pass up a good failure I never want to pass up the lesson from a good failure. Right. So, that's, the guy that wins is the guy that's failed the most, probably. So there was no grand plan. I had no net worth number. I never even knew what my net worth was until the bankers asked for it, for loans. All I was looking for was passive income. I wanted enough cash flow coming in that it covered my necessities, and then it covered my lifestyle, and then it covered anything beyond that. So you ask, how did it happen? A lot of it was by chance. You run into somebody, you do a deal, turns out to be a good deal. You run into somebody, do a deal, turns into a lesson instead, right?
Got it. So, one of the things I talk about often on this show is this concept of excelling at the thing that provides you your cash. You're focusing on your cash cow, and then placing your money with other experts. And I think the one exception to that rule is if you are trying to develop the skill and do it lifelong after that, which It sounds like is the route that you took. Does that sound like it matches you?
I kind of actually took both routes, and I totally agree with that philosophy. If you're really good at being a doctor, lawyer, architect, engineer, business owner, man, you know how to produce the income, you create that discretionary income, and try to find the right people to grow that. And I did do that. But I think growing up in the investment world by buying my own stuff, I think I had this sort of accelerated learning curve. And so my focus really, rather than focusing on seeing as many patients as possible, was always focused on doing the best we could for our investors. That was my job. That was the thing that we wanted to focus on. And we've done that for 20 years now. And that tends to grow the number of investors and perpetuates the need to continue to be better at what you're doing.
One of the you said that you focus a lot on cash flow, and I imagine in the beginning that's all you focused on. Has that objective changed over time? I mean, I saw that you have invested in some very non-cash flowing assets like venture capital. So how does that fit into your portfolio? How has that changed over time since you started investing at 30?
Yeah, it's kind of that philosophy of if you need a big bucket of money, that bucket looks like Mount Everest, right? So it's hard to take that down one bite at a time. I always enjoyed the cash flow thing because depending on how much I could create enough cash flow for the year, I could go back to my QuickBooks and say, you know what, I covered my utilities for the year. I'm not a rich guy, but you know what, my utilities are covered. Now my mortgage is covered. So I used that kind of continuous reward thing to realize I'm getting closer and closer and closer to where I don't have to worry where the money's coming from. Once that finished and the money kept growing, then I started thinking more about, doing some things. And actually, it took me a while, which people say, what would you change? Maybe I might have done. I wouldn't change anything because I love where I am. But, at least strategy wise, I might have done a little more speculative stuff early on. And so that's why it's changed now. I've got the cash flow, not the most wealthy guy in the world, but I don't have to work. And so sometimes you take, certain pieces of your income or your net worth or whatever cash you have to invest. And, I'll tell you, I've been the general so many times. It's really nice just to be one of the soldiers and just hand the money and let somebody else do what they do. So that's why I'm in certain VC funds, technology funds. I'm not a tech guy. I let them do what they do, and they're going to, some are going to be successes, some not. But I think that's a nice hybrid. I think it's certainly easier to conceptualize getting the cash flow to get you to a point where you've got more time, which means you don't have to really replace your income. Just take some pressure off. It's nice. And it makes you smile more, right? A little less pressure, you smile more. That's what I tell people. Just do a little bit because you get that taste, you get that addiction. You want another hit, right?
Absolutely.
So that's what happened.
That's how you get addicted.
Exactly. I wanted more and more. So I like to get people these quick wins and show them what it's like to have income that comes in, whether they're sleeping, cooking dinner, playing with their kids, vacationing, or working. It's really nice. But yeah, I think a hybrid, it takes more time to realize, but if you've got some of your funds you can put into something that, has a chance to do 10, 20 or 100x, realizing you may make that, you might lose that. You just put a certain portion to it. When they do hit, it really does accelerate the trajectory and gives you more money to invest in cash flow and some extra money to invest in some more speculative projects. So I am doing more of that now.
What are we talking? Are we talking like 5x your money? Are we talk like, compared to the cash flow deals? You're kind of making a comparison here, right? That investing in equity growth deals grow your wealth much faster in the absence of cash flow. But give us it in real terms. What does that look like?
Yeah. So in at least in my portfolio, I don't need 100x and too stupid to figure out what's going to be 100x. So, I'm in some funds that are projected 5x. And then there's a few that maybe 10. I don't know if I'm in anything that's 20x. That's really getting, so I say VC, but more later stage, VC rounds. But, so I don't do a whole lot of early stage VC. We're getting there though. I'm getting there. And a lot of the folks I hang around do that. So that's coming, but I'm not there yet. So yeah, I would say short to midterm VC stuff, 5, 10x, I'll graduate to 20 and 100x one day, but that's also going to create more failures because you're looking at those kind of numbers. You got to know that the majority of them are not going to make it and one might. So.
Right. Yeah. The basis of venture capital is 80% of the portfolio is probably going to fail. And you just hope the couple winners you have outdo the whole portfolio. What is, you mentioned that it's nice to sometimes sit back and be an LP and let your money work for you instead of you being in charge of all of it. The amount that you've invested as an LP is I would probably call insignificant in comparison to the amount of money. I think how much did you say you've invested 1 million, as an LP, but you've raised, 250 million plus as a GP. Why at that point Like if you are, are already doing everything on your own, why are you playing around in the LP space?
It's the people, and it's like 1 million to 2 million. Like you and I talked, I have to go add it up. I'm sure I'm lying to your audience. I have no idea what the real number is. But it's people. So, first couple deals were doctor deals. Got that MD after your name, you kind of get access to really sweet deals. You put in 50,000, you start getting 20,000 a month in cash flow. That's a pretty fair deal. Those are unicorns, right? So I did a couple of those.
Yeah, I want to find out what those are.
It's just, not open to the general public. And, it depended on my activities as well. I was an LP, but I brought business there. It's stuff that's not available. So I did that. But, the first kind of non-medical one I did with a friend. And so I'm friends with a guy named Kiyosaki. Everybody knows Kiyosaki, right? He wrote Rich Dad Poor Dad. So I brought Robert to Austin way back in 1997. And I had him give a talk. And a friend of mine was in there who was an attorney for a large retail. He did all the real estate work for a large national retailer, right? He comes to that meeting. He quits his lawyer job, goes into real estate, and does his first fund or his first project, right? So, of course, I invested with him just to support, right? So I invest with the people. I knew his due diligence process and all that. And I knew if it went bad, it was because of market. You don't want it to go bad because the person either doesn't know what they're doing or has bad ethics, for lack of a better word. So I invested with him. So I invest generally with people. I have found the few times that I invested in just a great deal and didn't spend as much time on the people, I've lost a lot. I've lost or was able to get out, that sort of thing. So it's I usually invest with the people, knowing that they've got good character, and then as well married to the fact that they know how to run the deal. So there aren't a ton of those. There's others out there. I put most of my I put my money in my deals. So I'm investing as an LP in a bunch of my deals, but I have lots of them. So maybe that's why.
Yeah. Well, so, something that I'm also interested in is you've mentioned that you've invested across this entire gamut of asset classes. And, what I'm trying to better understand is, did you just, you thought these assets were interesting and so you went after them, like not having any experience in them before, or you found a partner who was really good at it and you partnered up and, then you went into mobile home parks or office, like if single family, but then you jump into office retail and private equity, those are totally different boats and require different due diligence, understanding different market dynamics. Walk me through that.
So I think that, that attention deficit came in again. So I would try anything. So yeah. So and most of these were with my money. So the student housing, mobile homes, cell phone towers, things like that. And I put my own money, of course, into the medical office. So I was getting a lot of experience. So number one, that helped me in the future. I didn't realize I was gathering experience to find out either what I wanted to do in the future or what I wanted to stay away from, when I'm being restaurants, right? Because I don't know what I'm doing. And then the others, if I invested as an LP, it was generally to either support. Like I said, that was pure support for a friend. But I learned about it was retail centers. So I learned a little bit about retail. It was kind of nice. Great reports from my friend. So sometimes I'll invest to learn, assuming there's going to be a reasonable return. So it's a combination of learning and producing profit. I've invested. There's a tech fund that I'm invested in, helping to run and raise money, and I've learned a lot about the tech world. You still don't want me running a tech fund, but I'm learning. I'm learning. So it's selfish, I guess. I want the money and I want the education, so I'd like to get them both at the same time.
Yeah. So when you are taking on capital from investors, through your own venture, through your own firm, what are you primarily investing in, or is that across the gamut?
No, mostly it's real estate. It's mostly in the multi-tenant world, multifamily, build to rent, extended stay housing. That's our main business. That's what we've done since, 2009, right? So we have investors who've been with us and then my partner and I had investors prior to that. So we have investors who've been with us almost 20 years. So we kind of pretty much do the same thing. If it's outside of that, it will be either with somebody that's really, really good at what they do and has a track record, or, it's going to be that. It's going to be somebody that's really good with what they do and has a track record. Because I'll sometimes I've got value add portfolio where we purchase existing properties in the Southeast. I've got the technology portfolio. So I know the people. And I certainly the value add, we've done plenty of purchasing of value add. So that's right in the wheelhouse. The technology I ended up learning, but knew the people. So, I forget. I don't know if I got to the end of your question. I've kind of lost track.
No, I think you nailed it. So one of the things we talk about here on the show is, look, you should be investing with someone who it's their bread and butter day in, day out. They focus on whatever asset that they're focused on. And if you don't have that expertise, how do you go about determining what a good operator or a good deal is? If I'm thinking you mentioned something about private equity. If you're a big real estate guy and you started in the real estate world, how do you go about evaluating private equity funds or oil and gas funds to know if they're sound?
You bet. And I think a lot of times it boils down to what we're doing right here. So hopefully there'll be some nuggets of wisdom here from you or me, probably not from me, but, listening, getting educated in your network, your education and your network is your hedge against failure. You're still going to have some failures. But that's really important, and so if something interests you, number one, go learn about it, do what you can. There's only so far you can get, with academic stuff, you learn a lot more by doing. So, and then tap the people in your network. As you mentioned, we're in GoBundance. There's a lot of networks out there. A lot of them are free. Some of them are paid. They're all investments. They're all worth it because you can start leveraging the experience and the networks and the resources of other people. And you can learn about these things. Now, that's one thing. So, maybe you tell me about a deal that sounds good and you and I know each other really well and you've invested with them before. They got a nice track record. I'll tend, if I go into something like that, I'll tend to go in small because again, if I lose it, I lose small, but the size of the lesson's the same, right? So you learn best by doing. And, you've heard the story. You can do paper trading all day and you're a millionaire. And as soon as you put your own dollars down there and you start trading stocks or something, it goes to hell, right? So you learn the most when you got your money on the line. So I tell people, invest small, take the big lessons. You'll find out if it's for you or not. And then, move on. You're going to kiss some frogs. Eventually you'll find a sponsor or an asset class that really fits you well. And then you can start diving in even more. Maybe eventually start doing it on your own and bringing other investors in. But use the people around you. And it's not foolproof. I can promise you it's not foolproof because I did that and I got burned, but it's better than going in blind because as a friend of mine says, the prettier the brochure, the crappier the deal. So you would like, these days you would like somebody that's got some gray hair or no hair, somebody that's been through the GFC. Nice to have somebody that knows how fast things turn when things go bad because
GFC, Great Financial Crisis.
Yes, sir. It's nice to have somebody that's got some experience and track record. If and I, all candidly, there's deals out there that were set up in the last few years by folks that might have taken a seminar and might have never seen bad times and assumed that real estate always goes up or something else always goes up. But life is waves, man. There's up times and there's down times. And so it's nice to have somebody that's weathered the down times or can give you a plan for if things go bad. If you tell them, what if things don't go as planned? Well, we've got this, and this contingency, and that's why we think it's going to work. We've done sensitivity tables. We can withstand 60% occupancy if it's a real estate deal, that sort of thing. That's somebody that's thinking and knows at least how to look out into the future. Nobody can predict it, but you want somebody that's thinking about it.
So you mentioned, a key question that you might ask during a due diligence, interview. What are the contingencies? How do you deal with things when they go sideways? Are there other, key questions that, are always part of your due diligence process that you think about?
Yeah, absolutely. How many exit strategies do you have? That's kind of similar. Are you counting on a sale, or are you counting on rents to always go up or something like that? What are your strategies if things don't go as planned? Of course, have you got any deals go bad? Rarely does anybody have every deal go well. So you'd like to know what the deal was and what they did to get out of it, maybe what they learned from it. What's their communication style? I tell everybody that's running deals that, you don't communicate with your investors. After 24 hours, they're irritated. After 48 hours, they're really mad. After 72 hours, they start hallucinating bad stuff about you. So how do they communicate, right? And who's on the team? What's the experience on the team? Because that's huge. What have they gone through? Who does what? That sort of thing. Who are their previous investors? How have they done on the previous, let me talk to some investors. So there's a lot more, but kind of broad stuff, how they handle adversity, how they communicate, what their experience and track record is.
Yeah. And then I imagine you just wait to see if they squirm, or how confident they are in their answers, or if they just left they're putting on a show, or if they're just telling you straight. I imagine those are all easy things to pick up.
Yeah, you tell me you did anything wrong. Oh, God, let me tell you about this deal. We blew it. We picked the wrong partner, or we had this thing, but we got out of it. Life was okay. Or, that just makes you feel better. They quickly will give you an answer. And it's nice that they're putting there, especially if they're new people. You want them to have the old quote, skin in the game. But I'll tell you, so, when you do a lot of deals that are, $50, $75 million, sometimes it's hard to put lots of money into every deal, so, you want to know if they're new at it, that it means a lot to them. And if they've done 50 deals, it's not as important if they're putting skin in the game. It's always nice to have it, but it's not always possible.
That's a key note that I just picked up on. Yeah. So, something we talk about is if you're working with an emerging manager, that there's a lot at stake for them. There's so much on the line. They might not have as much experience, but they might have a lot more of their own money in the deal, or they know that if this deal doesn't go well, that the likelihood of them being able to continue along this career path is very low. And if you work with more experienced managers, there might be less money in each of them, from the general partner, because the deals are just so much bigger, but they have a better track record. But there's also kind of this thought that, if they're doing so many deals and they've gotten so big that, their latest deal, it doesn't matter as much if that deal goes sideways. What's your take on that kind of opinion?
That's true. And that's there, and that's where it kind of comes down to talking to, some of that character. We can't ever totally assess character, right? But, track records do help. The past does teach us. And so, and you kind of you want to look at the parameters, if particularly if, and usually most sponsors they're putting in some money, or they're bringing it from, or maybe they're even raising their sponsor co-invest. But you kind of want to look at the waterfall and still see, okay, these guys maybe they've done 30 deals before this, but they're not putting much money in. And, the split starts right away. You want to make sure you want to see that the investors are taken care of first, because, if the investor gets their preferred return and their capital back before there's a meaningful split with the sponsor, that means something, because that sponsor's putting, they're committing economic and time resources to this deal. So they do have a lot of skin in the game, and it costs to do this stuff. It costs them, they're paying employees and things like that. So that would make you feel better. But watch the splits, and I've seen everything. I'm sure you have. I've seen 95 to the limited partners and 5 to the GP, and I've seen 95 to the GP and 5 to the limiteds, and mostly everything in between, right? So you want to see what those splits are, what the waterfall is, and who gets paid first. And it should always be the investors get paid first, in my mind.
Something I like to, let me actually ask this question first, because I think it'll dovetail. When you mentioned that private investments make up over 80% of your portfolio, and that you're not invested in stocks, you're not invested in bonds. Why?
Okay. Control. I don't, the counterparty risk and the stocks, I think stocks I'm not a big fan of paper. I'm a hard asset guy. I like real assets. And so everything I'm invested in is backed by a real asset. There's absolutely no control in the stock market. And when you're running your deals, you got, a certain amount of control. Certainly can't control everything. So I am, I was a good little boy. I did what I was told when I came out of med school, right? Start a retirement plan, and you invest, you dollar cost average into the stock market. So I learned all this stuff, Guy had me buy what's called zero coupon bonds for my kids' college. That was the worst thing in the world. I'm sure his commission was great. Those weren't worth squat when I got rid of them. So I did all that, but I started watching. I watched my portfolio, 2001 up and down, got hammered. I invested with the star money manager of that year who had just crushed it the year before. Big surprise, our portfolio got cut in half. So I got out right before the great financial crisis. That was my only good stock call. And then, of course, I watched it go from 7,000 to 33. So I'm not saying it's bad for everybody. It's just, and I'm not saying it's bad. I'm just saying Tom Burns does not like stocks. I've done better by putting it in, real estate and hard assets. I like stuff I can touch. And so no ETFs, no REITs, none of that. Everything's backed by some kind of bricks and mortar or computers or something.
Yeah. And something I think about is that you can, oftentimes I feel like I get better returns investing in private assets than I would, generally in like the S&P 500, You've had some scars from, you've raised a bunch of money, you've done a ton of deals, you've been down the path. And one of the things I like to highlight is, it's not always sunshine and rainbows. Walk us through how some of your deals have gone sideways. Why? What happened? Like, let's go into the details so that someone who's about to invest and is maybe thinking about investing in one of these deals can, I don't want to scare anyone, but I think it is important to just understand how things can go sideways.
Right. And there's risk in everything. Certainly there's risk in the stock market we talked about, but there's risk in anything. And you read that private placement memorandum and it's going to have 20 pages of how you can lose your money. That's all done on purpose. But, most of mine came down to people. And this is sort of a mix of, my deals and our deals with my partner. I've invested with one guy who somehow managed to stripe the parking lot and replace air conditioners every quarter in one single office building, which was the reason why he wasn't putting out distributions. That was a small, easy one. I invested with one guy. Basically, it was a bridge loan for a guy that was doing this project up in Colorado. And by then I'd learned to do my due diligence. So I called a friend of mine, who was a big time friend. He said, "Oh, this guy is salt of the earth, a great God-fearing man. You couldn't do better than that. He's in jail." He, literally wrote me a check in crayon one time. And so, but I was the only guy that got paid money because I structured in quarterly payments. But yes, we lost some money there. One time connected with a young fella who was 25 years old, graduate of an honors business program, and then find out later he was 19 and got thrown out for cheating. We took that project over. I've had, let me see, one guy's gone to jail. One's been raided by the FBI. Two of them ended their own lives. One's been indicted by a grand jury. And, another one's been sued by the SEC. So all people. One of our projects, I picked out of town project. I picked the contractors / broker, was our connection in this out of town place, because you need somebody with boots on the ground. Deal was fabulous. Deal was great. He turned out to be a bit of a con man. Cost us a bunch of money. So that was our worst deal at Presario, my company. But what we did, Pascal, is I had a young, one of my directors was young, and she said, well, let's kind of fix it first. Let's not tell the investors, they don't need to know. It'll just bother them. It'll irritate them. I said, no, we tell them. I said, not only do we tell them, I called them, and I didn't say we picked the wrong guy, because guess who picked this guy? It was me. I called every investor and said, look, I picked the wrong guy. He's a con man. He's a crook. I said, we're going to do what we can to get it fixed. Every single investor but one said, stuff happens. I know you'll do okay, because we had these investors for a while. One guy said, okay, it's my first deal with you. I'm going to watch and see how you guys do. Well, it ended up creating a 9.5% annualized return for the investors, which at the time was our worst deal ever. And so that guy's still investing with us. But so it's a lot of people. This pandemic caused a lot of stretching out of supply chains, time frames, and we build apartments, right? So, you're expecting a 14-month build, and all of a sudden you're looking at, 26 months. You start amortizing your loan sooner than expected. Your costs go up, and so that has kept us busy and given us something to do over the last year. I'll put it that way. So, but that stuff happens. You can't control pandemics. You just have to react in the most appropriate manner. It's all based on trying to get your investors the best return possible, because you take care of them. You don't take care of them, you don't have a business. You take care of them, you've got ongoing business.
Yeah, one of the things I've seen kind of this divide amongst general partners, ones that believe, hey, the investors, they invested in this deal. It's either goes sideways, and that's kind of the reality of it. And then there are others that, will take money out of their own pocket and try to make the investors whole. Where do you sit on that spectrum?
Well, when we can, we sit. Well, we haven't had many of those yet, although we potentially have one coming up, and that's what we've done. So we've taken our own money, which is, again, sometimes we can't put as much into the next project. But yeah, we tend to loan the project our money, or once we even took money from another project, brought it in personally, put it back out to the partnership that had some issues, and made sure that the investors got taken care of. So look, because this doesn't happen often. We are, granted, we're not Mother Teresa, but we are not here. We don't put those deals together so we can make money. We put those deals together so we can give investors a good return and a good yield. And by extension, we will make money if we succeed. And I can promise you, we've been in closed door meetings where we look and see the investors, we're not going to do that deal because they don't do well enough. Or first we look to see how the investors are going to do. Then we back it up and see, is it going to be worth our time? Are we as general partners going to make any money? And, one of the deals I vividly remember, it was a typical 80-20 split, and we just weren't happy with the projected investor return. So we cut it to an 85-15. We took 5% less on our general partner side. So again, we truly do think about you got to think about if you got somebody that thinks about the investors when the door's closed, then you're in pretty good shape. It's still not going to keep you from having problems in the future. The market's going to throw you some curveballs, but I believe that you take care of them, you'll be in good shape. And you're right, though. The other side of the story is they invested. You told them this is, here's all the risks. You could lose your money. We're going to do our best. And if they lose money, of course, we lose more. So individually, and collectively, no, but individually, we lose way more than any individual investor typically does. So that's a part of it too. That's why they're accredited investors, or that's why the material that we put out lists the risks, and we talk to people. Nothing's guaranteed; it's always projected, because my crystal ball remains fuzzy. I cannot predict the future.
So how does if I'm looking at a deal and I'm trying to evaluate a general partner, a sponsor, the picture I'm getting is that you have to ask some basic questions. How do you do when things go awry? Tell me about bad deals. but there's some like, sauce in there, secret sauce of what advice would you give me or the audience of when you're evaluating a sponsor like that, right? Like,
talk to your friends, Pascal, talk to your buddies. Don't just, I'm serious. And I run a mastermind and say, hey, I got this great deal. It's like, well, I know those guys, good deal. Or I know those guys. Why don't you look for another deal? Right? Use your network. So that's the main thing. If you are out there if not blindly, but if you're out there by yourself and you see a cool deal, you don't want to take, I tell my everybody, don't take my word for it as how cool we are. Go talk to somebody else. You need to find a third party person or some sort of third party information that doesn't have a dog in the hunt that will say, yeah, those guys, they work hard. They do well. They've done well in the past. They're good people. What I gave you all the things that went bad for me. Most of it boiled down to is people, wasn't it? So one, you want to make sure there's some ethics in there. And then number two is, they know what they're doing. So you could be the greatest guy in the world. If you're doing your first apartment complex, I want to make sure you got some partners that have done them in the past, or else you're going to give me half the project if I'm putting money in it.
Give what are some key lessons? You've been investing for 30 plus years now. How is your mentality and mindset shifted over that period of time? What have you graduated to?
Yeah, I tend to invest only with people that I've known for a while. So I'll typically, if I see a deal, I'll maybe watch them. So it's because now I don't have to invest in a lot of deals. So it's going to be somebody that I've known for a while, or that somebody I know has known for a while. My due diligence continues to get better. I won't say it's the best, but it's, hopefully it's good enough. But, due diligence is really boring. It's really boring to ask those questions and you feel like you're sometimes being overbearing. But if somebody gets irritated, there's a reason for that, so the due diligence has gotten better. You do want to see numbers. You want to follow the money trail and know where everything's going. So my due diligence has gotten better. My willingness to invest, with somebody has to do with either knowing them for a long time or knowing somebody that's been close with them for a long time. Thus, I don't do it a lot. But if I bring something to my group, it's somebody I've been investing with for 5 or 10 years or known for that long. So there's just enough deals out there. You might miss. Fear of missing out is real. So you see this great presentation and it's going to be a 1,000,000,000% return. And, if you don't have somebody corroborating what you're hearing, then, maybe you might look for another deal.
Yeah. I mean, something I've thought about is I haven't done this myself, but kind of just top of mind is taking that deal that you have and bringing it to another operator and asking them to poke holes in it. What do you think about that idea?
That's a great idea. That's what masterminds are about. That's that's a little 2-man mastermind, right? You're bringing it to somebody who knows what's going on. We just did that the other day. Somebody brought a deal. Well, I knew the sponsors, good sponsors, that helps that investor feel good.
Has your investing changed with economic cycles?
Yeah. Yep.
How has that changed?
I've gotten a little more aware of, harboring some dry powder. It's kind of where I am now. Trying to harbor as much as I can. Somehow the war chest seems to keep emptying, but I'm trying to create a war chest. But, there are times, you want to stay in the market. You want to keep looking at deals. I had a buddy of mine owns 10,000 units. He said they underwrote 14 deals last week, made offers on 2, got none. That's what they do. 10,000 units. He's got a huge company of 300 people. So you got to stay in the market because if you're in the market quickly, you'll see when there's a change or you'll quickly recognize what's a good deal. So I'm trying to hold some powder for that. Or that dry powder is either going to be used for opportunity or for problems that I don't foresee. Problems that, I didn't realize were going to come. In 2001, I didn't know what was going to happen. In 2008, I thought, okay, I'm pretty sure I know what's going to happen. I still missed stuff. So as we go into what should be some sort of recession coming up, at least that's what the yield curve tells us. Well, I'm wondering what I'm going to miss this time. I'm trying to be set up so that if things go wrong, I've got some money to cover it, or if opportunity shows up, I've got some money to cover it and can act fast.
So you're not concerned about, missing the bottom or having, just too much cash on the sidelines sitting idle.
No, well,
like, how do you know when it's too, like when you should be, it could be this for the next 3 years and then it goes up.
Yeah. I'm okay with that. I'm in a little different situation, but but I try to hold my cash in something that at least keeps up with inflation. I hold it in some debt funds and things like that make pretty reasonable return. And you know what? If I don't keep up with inflation, but I don't invest in a dumb deal, then I come out net positive. So, and I'm pretty sure, Pascal, that I will invest in a dumb deal again. I'm going to do my best, but that's human nature.
Do you think, energy, I see this big energy crisis coming or it's happening, and so I want to invest in oil and gas, or I want to, I think, interest rates are going to go crazy and affordability is going to be really low, so I'm going to invest in mobile home parks. Do you think in terms of asset classes that way?
Not much. I keep an eye on the macroeconomics, and particularly if it affects, like I do have a natural gas investments. And so I look at that, I look at the war in Ukraine. I look at the warm winter that they had in Europe, and I look at where the gas prices are now, and I like where we are because I don't think they're going to go down. They either stay where they are or they go up. We're profitable at where we are. So I look at that kind of stuff. Interest rates, of course, we watch those all the time. Can't predict them or do anything about them, but we plan for them. So I watch that. And we kind of have our opinions, but there is that trap. I saw a deal the other day. It was they were counting on and planning on a precipitous drop in interest rates over the next 24 months. Might happen, but what if it doesn't? So you try to underwrite, if you're underwriting a 5-year deal, we underwrite it at today's interest rates. And if we get anything, and if it works, awesome. If it works, if it doesn't, then, you're hoping on somebody to buy that property from you, or you're hoping on those interest rates to go up. So hope, my friend calls it hopium, right? You don't want that to be part of your business plan.
When you're, now, are you focused on multifamily just moving forward, or what kind of deals are you looking at right now, given this environment?
Yeah. So, like I mentioned, it was a year ago, January, that we hacked the pipeline, which was one of the best moves ever. But we could see interest rates were getting ready to do their thing.
What do you mean hacked the pipeline?
We had a big, robust pipeline of deals that we could have, raised money for and proceeded with. We decided to shut them down. We kept the best of what we thought was the best of the best. And so far, it's looking okay. We might have been in trouble if we'd have gone that big that year. Just didn't seem like the right time. And those were in apartments. And so right now, apartment development's taken a bit of a pause. There's been a lot of overbuilding, but overbuilding in a town like Austin, we're gonna over deliver shortly, but it won't take too long for that absorption to take up what's there. And then if you start building, then there's a big gap. So that typical development out, overdevelopment, and there's a need. So we're 6 million housing units down over the next 10 years or so. We're like 4-point-something million apartment units. So apartments are they look good long term. They look very good. Right now, there's still rent growth. It's just much lower, much decreased from what it was. The interest rates are keeping first-time home buyers from buying homes. So where interest rates are right now and inflation, that's working for the rental world, works for apartments. So it takes us a long time to do a development. So we've got a number of parcels of land. They're in various stages of entitlement. We're ready to pull the trigger when we think it's right. So we are a multifamily firm, and that's what we're going to do going forward. It's going to be development and acquisition, just depending on what we find acquisition wise. Branch, sort of on that same road, but maybe on the shoulder, we've got built to rent, which is sort of horizontal apartment complexes. They run relatively the same. We've got a couple of those projects. And we're in the extended stay world, which is it's sort of a hybrid between hospitality and workforce housing apartments. Those particular products are used by people that are working. It's not discretionary income. It's not people vacationing most of the time. It's people that are, spending 3 to 6 months in a place to do a project. In my doctor world, we have travelers that spend 3 to 6 months working in operating rooms, traveling nurses, traveling techs, traveling doctors. So the metrics on that are good. The big money's put billions into it, and so that's something we've been working on for 2 years. So still in the multi-tenant world. So that's what we're doing now.
Tom Burns dropping knowledge. Tom, this was awesome. Thank you so much for joining today.
It was really fun. Thank you. I'm sure I rambled too much.
No, that's where all the gold was. So I appreciate that. So thank you again for hopping on the show.
You bet, buddy. Thank you.
Take care.